Welcome to the new episode of Blockrevision. Today I would like to make a recap of what happened during recent weeks in economy, but mainly I'd like to focus on what is going on this week, because the thing that is hitting up the market is this Fed's meeting on which we'll find out what's interest rate hike ahead of us. So it's very important gauge that will probably impact the market in that way that have its I would say bigger or weaker volatility regarding the point. So I would like to get straight to economic data, but at first let's have a look at specific things that are regarded to economy. So I would like to just I will show you out the Fed's meeting that has a goal of to fix things that are not working while minimizing the spillover negative effects that might come to other parts of the economy. So for this I would like to make a quick change of a window. So I would like to just hang on for a while for loading up some content. Right now we are in so that's the window I want to load up. Alright, so I would like to extend this out, and that's some of the points of what we may expect from the Fed's policy review today. So we are looking for such data as size of hike, the amount of dissent, statements, and guidance. So these are the main points where we will would like to ponder about. So the whole market is expecting that the Fed will hike interest rates by 75 basis points. But as we know, there is no Fed's meeting on August, so that may be even higher, with this expectations that the also inflation rate gauge may get maybe a bit of the chart. So with this one, I'm leaving you, and we'll get there tomorrow at the same time to discuss this over. So for now, I would like to focus on other parts that already recently have been very important for this recent days. So at first, I'd like to focus on what is going on in China, because what's happening in China impacts to the big extent the whole world. So in China we can find that economy expands slowest since Wuhan lockdown. So we can find that this gauge is showing us that after this pandemic outbreak we are right now going through very difficult time, and without any specific rebound from here, I would find that the whole world would have its kind of issues with supply chains, especially. In terms of credit rebound, we can find the situation is getting a bit better, because China's credit jumped much more than expected last month, to the highest on record for June. So right now we can find that the central bank and the government is starting to have an effect on boosting the supply of credit to the economy. So especially as been marked. But what does it mean for us? China is looking at the other side of the coin. China may become a pariah for global investors, as recently this type of policy has scared lots of them. Just look at the dwindling inflows right now that are collapsing, and the most investors decide to sit on a sideline and hang on for what may happen. Now, these are the problems concerned to geopolitical risks, and also this COVID-0 policy that also where we can find hasn't got its end in sight. So especially with this COVID problems seen still on a side. In terms of overnight borrowing costs, we can find that in China we can find that money are being pumped out of thin air recently. China's borrowing cost slump shows limits of PBOC policy easing, and right now with this one, with this many trillion yuan been sitting on the sideline, we can find that excess cash that is piling up in the financial system instead of it's looking like just sitting right there instead of being funneled to the real economy. So that is why we may go through a risk of a liquidity trap, a situation where monetary easing is unable to boost demand. That's why there might be a lot of things that may put Chinese government into trouble. As of next, I would like to just stay here for a while. We can find that China is struggling with lower commodity interest. Just look at that. Chinese hunger for commodities is wavering after years of growth, and among them there is a Chinese crude imports on track to decline for a second consecutive year, and also China is cutting back on LNG import as well as palm oil are historically weak. On the other hand, iron ore is climbing, but this is one of the not many goods that has its imports bigger than recently. So demand for the most ubiquitous of edible agricultural goods has suffered recently as China's virus restrictions sent a chill through for instance, catering industries. So that's something that makes me a little bit more distanced, more reserved from what's going on in China. Quantitative easing, as we know, recently were really skyrocketing, and was the one that hasn't been seen before. So US brought money during the pandemic was exceptional, and also this division M4 is monetary aggregates index, that is an index of money supply, and with this one we had an abnormal situation that has led to some abnormal outcomes. But with this one broad money supply being taken off the table, we may find that these problems that recently were tried to be fixed by merely this money supply might right now revert. So this is quite also something that maybe quite of trouble. Right, but whether it's quantitative easing or tightening, neither of them is the flawless solution, as we can find that the world has a global debt that topped recently a record over 300 trillion in Q1 2022. So this QE looks like a bodybuilder doing steroids that right now a quantitative tightening looks like this steroids been taken out, and that's why we can find that tapering may give it a few months, and we go back to the natural physics and strength. So this quantitative tightening is the compensation process after this quantitative easing. So we are getting back to the point zero, I would say, because there are many solutions that are not being solvable by whether QE or QT. So on that hand, there is no easy solution. Looks as we are suspended in a void in between Q and QT due to inflationary pressure, but those debts must be redeemed. We can't forget that. So that was from here. COVID-19. Yeah, I already mentioned that we are still maybe before another wave that will flock Europe and US this fall. As of next, recently we were talking about commodities, and exactly investors are betting that Fed will need to cut interest rates next year to bolster the economy. So this recession clouds are just, I would say, hanging over the markets, and that's why we consider that Fed may take some steps back in the beginning of 2023. Right now, that's why more and more investors, as we can find, are turning into bonds that recently suffered much, and that's why the many of investors are also expecting that the probability of recession will increase over the next 24 months. That's why they're buying, for instance, 5-year bonds. And that's the chart of US 10-year minus 2 years, and that points that a recession in the US seems likely. Historically, a prolonged yield curve inversion has been a good indicator of recession. So many investors use the spread between those yields, this 10-year and 2-year bonds, as yield curve proxy, and a relatively reliable leading indicator of recession in recent decades. Some of analysts claim that maybe better to focus on short-term maturities is more informative about the likelihood of a recession, but that's kind of a popular one. So that is why we still use it, and it has some forecasting power. So stocks buckled recently under hot CPI, and we can find that this multi-year mantra of Tina, that means there's no alternative to equities, is facing a major threat, as bond yields are looking right now more attractive for the day, especially as CPIs and this inflation brands has problems with pushing this inflation on consumers, as consumer sentiment is going downturn. Recently, commodities is the one of the sectors that maybe one of the forecasters that are telling us that what's the condition in the market. I recently has thought about the copper that has kind of a relation to the market that precedes the behavior on in the economy, and that's why this recent leg lower of copper showing some problems. This one has been tied to increasing headwinds to European growth path, and I would say in particular from the impact of surging regional natural gas prices on activity. So lower prices might be needed to encourage producers to ration supply, though it's said actual production cuts would only be needed in a worldwide recession. So that is why the copper might be an indicator of tougher times yet to come. Especially turning to other commodities, we can find that with dropping oil, that recently we have also found the other commodities have a tendency to follow. The bank said the commodity, many of the banks, especially Morgan Sachs or Morgan Stanley, say that commodities still have a way to reach bigger and higher levels in 2023 and 4, but this year especially showing us that there is more of a weakness rather than strength of recently. So that is one thing that we will would like to also point out, that resources flows right now at a nearly -6 level. That is showing that many of resources are outflowing the market. Global credit impulse, however, is getting weaker, and we are waiting of what Fed may do. So commodities are dropping, but it's very difficult to seek a parallel to previous recessions, as there are many of gauges that behave in a kind of a different type of behavior that has been previously registered, especially inflation, employment, and other spreads between Italy, Germany bonds are showing that is kind of a different situation that where we were back then. So we can find some parallels with previous crises, but we need to bear in mind that there is many of differences. So getting back to global credit impulse, we can find that we are right now in this area that is lowest ever been registered. So it means that sentiment around is very, very low. But everything stems to what Fed will do. If the Fed continues on its rate hike path even after signs of recession become more prominent, the curve will continue to invert even further. So we need for this to revert some dovish voices that are right now lacking, that are really, really nowhere. So it looks like there's commodities and equities long-term cycle that have been recently put over is getting, I would say, more silenced due to I would say, even with this production capacity, lack of production capacity, we can find that that's why we need to either listen to what market is telling you rather than forecasters. And this is the coming credit crunch, also another article. That one has been posted by one of the economists. Also very interesting chart that is pointing us that cyclicals, including housing and durable goods, only constitute to 15% of GDP, but the swings account for variations between growth and recession. So this is exactly the chart of cyclical component as a percent of GDP, and right now in the past shown that it has some effectiveness of forecasting recessions. Right now we are in a area where we might be heading backwards, but it's still too early to say. So right now this I would say line would not have a chance of getting much higher, as we don't have, for instance, the demand of the 70s to maintain that level of housing and durable goods consumption. So that was one thing that is showing us that we still have a room to go down from here. The German economy is moving into recession. That's the Deutsche Bank says. We can find that more and more voices are showing like this, and it's reasonable to assume that Russia will continue to look for ways to disrupt economic activity in Europe in retaliation for Western sanctions and financial and military support for Ukraine. Morgan Stanley strategies see European profit cuts accelerating, and that's something also that may put Euro area into trouble. So recently we also have had a ECB's interest rate hike that they have decided to make it by 0.5 point. That was surprisingly high to economists, and right now it means that those programs such as TPI, that is a new tool that allow ECB to buy bonds of countries it believes are experiencing an unwarranted deterioration in financing conditions at any time they want, is telling us that ECB is preparing themselves for even more interest rate hikes in the future, because with that they will possibly are able to help weaker economies in Euro area without risk of defaults. So earnings season recently started, and right now lots of economists are expecting shrinking profit margins. Right now, I would say that these growth companies such as Google and other companies that I will tell about are not suffering to that extent that previously been thought. Tesla had better results than forecasted, and also other growth companies as well have a chance to get a rebound and maybe get another flow of attention from the public. US maybe is trying to avoid the recession because of its economic strength and also kind of a independence, energetic independence, but there are also many doomsayers, for instance Michael Burry, also Mr. Doom, Rubini, and of course Robert Kiyosaki, that are expecting that the collapse, very big collapse is coming. But whenever there is a three biggest doomsayers on the horizon, expecting the very strong collapse of economy, I wouldn't really listen to this, because whenever the many or even all of the economists are expecting one result, the market is the most likely to make it another. However, we still have a chance to get to lower GDPs that recently been noted. Recently, Goldman Sachs forecasted that GDP will extend by 0.7 points in quarter 2, but recently it even been shrinked by another institution, Bureau of Economic Analysis, showing that this estimation may get to just at most 0.4%, but there is no recession in sight. However, tomorrow will be this decisive day where GDP growth will be introduced to the public. IMF also cuts GDPs, and in 2022 for the global GDP we can find that expectations are at 2.3%. So these are GDP's cuts. US growth is looking sickly as Fed keeps hiking rates. Right now a rate decision is coming up, and I wanted to point out that US 2Q GDP is still growing at steady pace after declining in prior quarter. So that was many consecutive projections of another different analysts, and this first of them were at plus 0.7, another at 0.5. The most recent one was at 0.4. It means that these projections are getting lower and lower, and that's why we are expecting to show up kind of a negativity, maybe very close to neutral zero level. In terms of forecasts that are registered on Trading Economics, this one exactly showing us 0.6 projection. But getting back to where we were is another gauge that is positive, that exactly the market is expecting peak Fed aggression that will just have its highest point in this month. So after this interest rate hike, we may find out the worst is over already. These are the economies, some of the economies that are showing us that still we have a chance to bigger interest rate hikes. With Australian jobs growth extend, unemployment tumbles, we can find that those central banks still have a chance to follow their guides. Gold markets are reverting to bad news is good news, but more pain is coming. That's very interesting, as recently we can find such a projection that 1 month correlation with US MAP score weekly changes showing us that whenever the bad news is showing up and flogging the market, the market showing a reverted tendency to US 10-year. So recently this reverted tendency has been seen very clearly. As of next, Google has shown up recent earnings data, and due to this, we can find that despite lower ad revenue, we can find that we have got to expectations, and that means that right now the market is trying to defend itself from recession time. So there was maybe a little surprise to the downside by minus 0.06, but it was much better than recently been expected. That's why Google, as well as Microsoft, that surprised a little to the downside, is showing still the strength of the market, and the possible rebound is highly expected. Right. So these were some of the earnings data. We are getting back to earnings. Walmart, however, showing us that still has some problems after recent slump, but many of these value stocks are not suffering that much that recently we would call that it might be a very high likelihood of recessive tendency. So McDonald's posted sales that surpassed investor expectations, while Coca-Cola lifted its outlook. Both got a boost from price increases. So that's positive and gives a chance for the market to stay for GDP at over O level. Right now we can find that percent of stocks above 50-day average is getting above 50, so it means we are trying to get out of this bearish funnel that we have got into in the beginning of 2021. After this one been got out, we'll get to better days, to 77.5 points that I wish that will happen. And as a positive aspect, globalization is just getting started. Maybe it's not getting as strict as it was previously being expected. So globalization is still on a good way to thrive, even with this wartime. Right after, we'll find out that more countries are questioning the value of greater trade and political integration. So that's it from that news. Yellen says that US and its allies should use friend-shoring to give supply chains a boost. So it means that Fed is trying to maybe deglobalize for a while, but normally it would mean that there is a kind of a change in tendency of where those allies may be taken. So friend shoring goes beyond that, but limits supply chain networks to allies and friendly countries, as showing us that maybe the President Biden should turn to another allies. That doesn't mean literally that the globalization may take place. In terms of market outlook, quickly I would get through a PE that is higher than in past bear cycles. Aggregate US equity futures positioning is lowest been registered recently. Many metrics are not yet at bear market bottoms, as we can find that quickly showing that CPIs may get even worse. Unemployment rate is at a very good level and may get weaker. High yield spreads still not as it been on the recent crisis troughs. That's why we still may become cautious and stay kind of awake to the results. Top of book depth is still at a level associated with market stress despite recent improvement. This one is also something to ponder about. Slashed estimates US earnings downgrades at levels last seen in 2020. So that's something also that may get reverted after this earnings season to happen. S&P 500 GAAP earnings showing us that might be a tendency to flatten this really strong rising curve, but it doesn't give us 100% certainty. In terms of crypto outlook, I would like to start with total hash rate that right now is getting past 190s, but still we have it at the highest level in June and May, and right now we may get struggle in terms of getting passed through this. Right now, the bigger magnet, I would say, is this level of 180s rather than 200 terahash per second. So that means that more and more market participants are getting out of the market. Multicoin Capital announces new venture fund. So whenever those news are being found on the market, it means that there are still many people willing to invest in this sector in risky assets. So it means we are still far from the possible bottom. So because the bottom is the situation and the place where very few market participants are willing to pay and invest in the time. So whenever we can find those news, I would rather stay cautious around. In terms of Mt. Gox, that right now is scaring lots of market participants, payouts aren't going to torpedo Bitcoin's price, as article says that there are many long-term holders that right now expecting that even when Bitcoin will get lower in price, they will still buy in even more, and there will be no selling pressure. I'm not so sure about it, but Bitcoin, these payouts may take place in throughout August, and that's why I don't find that Bitcoin might get another boost of attention by that time, because this, I would say relentlessly, many of investors would like to run away from this asset that recently been hacked from them. The next one, crypto winter, has 250 days left if the market cycle repeats. That's what Grayscale says. That means that the end of bear market will be somewhere around the first or second quarter of 2023. The next one, regulations are flocking the market. Coinbase petitions SEC to propose rules for trading, and Coinbase have difficulties in defending themselves from that they haven't make a debut of any of securities. Right now there's a kind of a regulatory battle between Coinbase and SEC regarding the explanation of what really is securities. The regulatory problems are going into investors that are dumping Coinbase shares. Even Katie Wood that bought the shares at around $300 right now. Are selling those shares, and that's why Coinbase stock plunges even higher. Bitcoin market price and average cost of production right now is in a kind of a dispersion, and it means that there is still kind of a room to go downturn to justify that those miners are getting off the market. Recently, in 2019, Bitcoin miners were the entities that after running away from market has cleared out the sector, and that was the time where the market started to revert itself. So the next one is MVRV chart that is showing us that right now we are in a very, very low place, that helps us to assess the deviations between spot pricing and the aggregate market cost basis. There might be kind of one of an indicator of a possible bottom, at least for now. In terms of BTC futures funding rates, we can find that the more positivity is getting back to the market, but still not very much to make a clear bets to the upside. However, as we are still in a bear trend, I would still bet on that we may get downturn even from that levels, that relatively low levels of around $20,000. On Bitcoin futures, perpetual funding rate right here is also showing that more and more investors are betting on the way to the upside. But unforgettable is that the trend is still to the downside. As SEC extends the window to decide on ARC21 shares spot Bitcoin ETF, and that's a kind of an important thing, because spot ETFs are showing us that there is a kind of a respect for blockchain technology. In terms of ETNs. The problem is that these companies that possess ETNs and offer Bitcoin's ETNs for its clients don't have to possess any of physical Bitcoins. So it means that even with Grayscale and other brands that remains committed to converting their funds to the world's first Bitcoin spot ETF, some of which sued the SEC if its latest attempt don't go through. In opposition, the SEC claims that market manipulation is its largest hold-up to Bitcoin spot ETF approval. So while spot Bitcoin ETFs are certainly more legitimate than Bitcoin futures ETFs, as they involve actually buying Bitcoin, it's hard to say which is really better. But that's something that the sector is waiting for, those physical Bitcoins, Bitcoin ETFs. Bitcoin correlation with stocks near lowest level of 2022. That's very important to decouple from the market, because Bitcoin has its name, I would say, different from the regulatory market, and that's something that differentiates from the whole investments assets. So that's why decoupling is very important, and showing this one right now is meaning that we are right now in a good position to get over this. NOPL, that is net unrealized profit and loss, is showing us that we are right now at that levels that been seen, even lower levels that been seen in this March's troughs. So we are just heading downwards to the lowest levels ever been registered since 2019 and 18-19, I would say. The next one is market movers, and we are, as I said, awaiting for a Fed meeting that will be taking place today at 2 p.m. Today we already had consumer confidence from France that shown lower and is equally low to 2014 levels. So that's very, very low. What was this week as well was that from Australia inflation rate turned to 6.1%, so it means the inflation rate is also speeding up in Australia. So that's why RBA should still take some steps to interest rate hikes. In terms of earnings, we already had, as I said, those brands as Visa, General Electric, and it's shown us very good data, and more or less many and most of the brands is showing that those outcomes are kind of a good. Bank surprised to the downside. That was I would say of high of a expectations, because of the laid off personnel of many of lines around the globe. Right, so Bristol Myers has surprised to the upside. We still have Ford Motor and Qualcomm and Etsy still to be published. And at the end we have Trade Idea, and recently I would like to take a notice on Burn Barn Bridge, that is with a ticker of Bond, that allows its users to manage or take some bets for against interest rate fluctuations and price volatility. So this coin recently skyrocketed on that level of 19 USDT on Binance, but I would like to take a notice that right now we are just meeting with a very strong resistance. That's why I strictly aware you from taking any of the bets to the upside. If you have a futures on bond on any of exchanges, I would even bet against bond right now, as there is very low probability we'll get over this very strong resistance. So in terms of trade idea, there might be even very good entrance right here with a stop loss right above 25.5 and with a target to even $7 bucks. So Barn Bridge may be a good token, but right now, technically speaking, is in a very good position to short, especially with breaking this 25 EMA. We are right now on the way to test 200 EMA on the hourly chart. So that's it in today's episode. Thank you very much for watching. If you found it interesting, hit the thumbs up button, and if you have any questions, just put it in the comment section below the video. Tomorrow we will see each other at 15 to 3 and hopefully see you there. So have a good investing, and if you don't understand what market is doing, just sit on the sideline, because there are lots of market publications still being made this week, so stay cautious. Bye bye.